All right, guys, welcome back to Capital Mindset Call Show. This one's being done. Anyone can see it. I think that given the circumstance, also, and I've been seeing some of the commentary here and there in the community, other communities, people are freaking out and stuff. So I feel like it's just good to have just this call. Anyone can join. If you're seeing this recording and you're not there live, I'm not saying I'm never going to do this again. There's going to be plenty of times. By the way, if you didn't know this, there's a lot of hangout sessions / impromptu calls that we do all the time on the server. So if you didn't know that, I'm letting you know via this recording. See this. But anyways, getting right into it. We had an absolute bloodbath today in the regional banks. We're going to start talking with SVB Financial Group. Now, SVB is, how do I put it in the best way possible, or to kind of explain it, but they have a lot of B2B relationships. Most likely you're not going to have, I doubt if you're watching this, you have a banking relationship with this company, but the majority of their clients are larger enterprise, larger businesses. I know that a lot of asset managers do use SVB as a custodian. They'll use it as their bank accounts. Same with like First Republic, which we'll get to in a second. But SVB, there wasn't not anything inherently wrong. And Gold members know we talked about SVB a long time ago now. I believe we talked about it in a call back in September or October. I could be getting my time frame mixed up, but I do know we did talk about it. And another member, Ricky, if you're listening to this, you definitely remember because you were asking about this company back in those days. And the conclusion or consideration was the unknown exposure they had to some, let's say, questionable tech. And that actually ended up not being the issue. So now that the story's kind of given time to develop and we were able to digest it, and we had these, voice sessions throughout the day today, the consensus, how we all understood it, was there wasn't anything inherently wrong with her book, actually. That wasn't the issue. Well, there was an issue, but it wasn't what we traditionally think of with banking, that, they made a bunch of degenerate loans. It was more to do with the fact of the duration of the loan. So the loan duration was far enough into the future as though if and when the clients, the depositors wanted those cash flows to, let's say redeem it for whatever reason it might be, the bank was unable to secure it at favorable, let's say, rates. What do I mean by that? Well, we know that interest rates last year, we saw them rise throughout last year. In fact, if you were short bonds last year, you did really well. And even today, or up until today, yields have risen from the bottom, but they're still nowhere near where they used to be. So when I say actually yields, I should say yields have fallen from where they used to be, but they're still nowhere near where they used to be at their lows. But anyways, so what we're seeing in the portfolio of these banks is the value that they could sell them for, of course, has come down. And some of these banks have grown their balance sheets tremendously throughout the pandemic. If you also recall from the calls, and I'm going to just mention it briefly to kind of get everyone up to speed, Wells Fargo is my favorite bank of the big banks. And I think that the ultimate scenario, and I'm not talking about consumer banking, right? I'm not talking about your relationship with Wells Fargo. It might be subpar compared to other banks. Again, my personal favorite bank to deal with, and that differs for some of you listening today, is Bank of America. I also like JP Morgan Chase. I'm talking about in the category of big banks. I do believe that if you have a smaller banking relationship, you might find much better treatment than you would at the big banks. But, that's why you should really shop around. You are always right. You're the consumer. So anyways, getting back to the topic at hand, you had SVB essentially having to sell some of these assets to, get enough liquidity, liquidity crunch. If you guys remember that word, well, you basically witnessed a liquidity crunch in full effect on a micro level, not a macro level, but a micro level. Now we'll see if it spreads, but for now, we're just seeing it on as you've been seeing on the news, they're all using the same words, classic bank run, because that's what this is. So the bank itself did not do anything too degenerate. Okay, the only thing you could point out that is quote unquote degenerate is lending too far along duration, right? Lending too far into the future. Now, in previous calls and previous videos, I talk about why banks, or why the banking system requires, and that's the keyword, requires short duration debt. It's because of how liquid they are and the surety of the value. You don't have yield risk or interest rate risk. You don't have that with short duration. So if you're talking about the most pristine collateral out there in the market, it's short duration treasuries. So people ask all the time, right? You'll see this on the internet. You'll see economists, talking, maybe not economists. I doubt it's really economists, but you'll see people, proposing the question, and it makes sense, right? You think about it, you're like, well, I know the U.S. government has a ton of debt, right? We have this debt ceiling and all that right now going on. I know they have a ton of debt, and interest rates, they were really low. I heard this chatter a lot when interest rates were really low. They said, well, it makes a lot of sense if the government were to just, borrow all that money on the 30-year, right, and just secure it. Because you're thinking about it like, from your own perspective, like a household, right? You're like, I'd sure love to borrow at really low interest rates at 30 years and lock that in for 30 years. That'd be fantastic. And yeah, the government obviously, of course, would like that. But if they did that, that would starve the system from much needed collateral. And so you'll notice that the vast majority of government debt is on the shorter duration side, because that is a tool as much as it is an investment per se. So it's actually explains why you're going to see or you're going to witness a decent chunk of, let's say, market participants purchase negative yielding assets, because they serve a greater purpose than simply return. They also serve a purpose of collateral. So between bank institutions, et cetera. So it's a way to kind of shore up liquidity, so to speak. So yeah, that's kind of what we witnessed here today with SVB. The lack of duration exposure really kind of handed them out. And I'll say this from, if you're working right now in the financial space, you might have, of course, received, I guess, a corporate-wide email of sorts, kind of warning you for whatever reason. Because there's a huge proportion of, let's say, startups across the United States actually had exposure to SVB. And the I guess contagion question, the contagion risk is for something like First Republic, right? So First Republic is another bank, and I'll go ahead and put their ticker here on, so FRC, I believe it is right there. So FRC is actually also down 14.84%, and you can see it's down 3.94% after hours. We were talking about this one in the voice call today. You guys can check it for yourselves and see in the voice chat. I believe at like 240 something, I exited the position that we kind of had just fun, guys, because I'm not a day trader, but just for fun, I purchased a decent amount of shares of First Republic, and we had some fun there. But the point being, the pain here, I wouldn't hold it over the weekend. And again, that's what it was. If I lost money a little bit, fine. But I made money, fine, great. But I didn't feel comfortable holding it over the weekend because, you could see on Monday that, things calm down and First Republic makes a massive recovery. That could be the case. But I really want to take a pause here and kind of say, like First Republic, they also don't have a problem with their book. You're not dealing with that, right? It's another unforeseen consequence. So not only do you have to have a good book, not only do you have to have, safe assets, but you also have to have liquid assets. And so that's going to be more of a thing brought up with First Republic. Do they have enough liquid assets to meet the demand? More than likely, I would say no bank has the totality to meet all the liquidity. If, for example, let's say everyone were to request their capital, and even the FDIC doesn't have enough liquidity to do that. And it's kind of funny when you kind of start to map out the plumbing of things. The U.S. government needs the banking system to provide it with cash, liquidity, et cetera. So who's laying the eggs here, chicken or the egg? Who's what? But I do believe, like I said, I see Imagine buying calls 3XL SDAO. So I kind of agree with what you're saying there. Honestly, I expect things to calm down on Monday after people get a chance to research what happened. So if that were to be the case, I would suspect that you could see like FRC over here, kind of make a, let's say whatever you want to call it, a decent comeback or something. But I think that the risk of contagion here is fairly muted in real world contagion, because I think people would have to be really silly, because again, if it wasn't for the fact that there was like a run, you had Peter Thiel come out today and say what he said, get your money out of SVB, etc. If it wasn't for that and people were just calm about it, the bank would be fine. The assets would be fine. They didn't have anything in there that was going to blow it up. That's not the issue. This is not a SoFi. This is not a what's it called? Credit Acceptance Corporation. This isn't even an Ally. This is a fairly respectable, safe portfolio book. And okay, going back, because I don't want to get on too many topics. The reason why in previous calls, to kind of get everyone up to speed, why I say I love Wells Fargo so much, again, not from a consumer's perspective, but because the book quality is very, very high. And the liquidity there, now we're judging it on that front, is very good from the side of, and these are money center banks, right? So the reason why you saw actually relative strength by money center banks is because of the ample liquidity that they all have. So there's a thought going around, well, and it's funny because I had a conversation today with a business owner who has a decent amount of assets, and they actually brought up that question to me. They say, well, what do you think if I move my money, and it was a small regional bank, what do you think if I move my money to JP Morgan Chase? And I took a pause there in our conversation. I was like, wow, okay, that's really interesting, because you're hearing this narrative not just there, and maybe they listened to CNBC that day and they got that idea or something. But I'm seeing if that kind of spreads, that sentiment, it's interesting. But point being, the thought here is that the money center banks, they have everything to gain here and not much to lose. Now, Wells Fargo, of the money center banks, I think is the best capitalized. They're the ones who can weather pretty much almost any storm. What I've spoken about in the past and explaining to you, the quickest way possible I can say is the asset cap has been both a blessing and a curse. New CEO comes in, rock star guy. I think he's the spiritual successor to Jamie Dimon. He kind of reorganized and shuffled through the book and kind of trimmed out the fat, the disgusting fat, and focused more so on maintaining a high quality book. So if you see the asset cap lifted on WFC by the Fed, that's actually going to be kind of a double whammy if we kind of enter into a more questionable period for banks. Wells Fargo is going to have the ability to pick and choose what they want to accumulate. Think of, for example, SVB. You want a perfect example, look no further than them. Perfectly good book, and they're going under, and they're going to have to find someone to give them liquidity. So what do you think is going to happen there? You're going to have bidders, of course, but of course, who would not want this, right? Who would not want to take apart SVB's book, which is still of good quality? They just didn't have the liquidity. They messed up, but it's good quality there. So you can now afford to probably get it for pennies on the dollar, and not pennies on the dollar, but less than what you would have otherwise gotten for. And before, while maybe it wasn't for sale, now it is, because out of desperation, you get these opportunities. So the best scenario for Wells Fargo is we enter some sort of liquidity crisis, a secondary liquidity crisis, and you get an asset cap lift from the Fed. If that happens this year, Wells Fargo is the best bank positioned. Because you had JP Morgan Chase, which is still very well positioned. Bank of America, still very well positioned. Even Citigroup, better positioned. Money center banks, get the theme there. You do, at the end of the day, have, let's say, a book that has grown substantially even throughout that time period, throughout the let's say the pandemic. So it's not like they missed out on anything. The only one that's missed out is Wells Fargo. So while JP Morgan Chase's book is still of high quality, and I was talking to Cole about this because he was bringing up questions earlier today about this, kind of saying, hey, well, what are the better banks, et cetera. JP Morgan Chase is among the top, if not the top, which I know among you guys there's a joke, inside joke. If you guys need me to explain the joke a little bit better, there is an individual out there who, of all the banks to short, they chose to short JP Morgan Chase for whatever reason. I can't for the life of me explain to you how their thesis made any sense, but that's the one they chose. I'll tell you right now, if that's your choice to short in the banks, I I would say you're heavily mistaken. If you put a gun to my head and said you had to short one of the big money center banks, I would tell you straight up Citigroup, because of the money center banks, the greatest risk profile, the lowest return on book is Citigroup. So they have perhaps the greatest amount of counterparty risk present, but you know they're still a good bank, right? All things considered, they're still a good bank. They're not the best bank, but they're still a good bank. Wells Fargo is among the top, if not the top right now for my pick, okay? You do also have some other regional banks that have been destroyed and I think are good quality. So I'm thinking Truist Financial Corporation. Honestly, another one that got kind of smacked here, not as much as First Republic. Again, First Republic is more comparable to SVB. That's why it's getting smacked so much. And again, that's probably, if I'm looking for that alpha here, or let's call it more speculative play on you know, people are just crazy. People went crazy, blood on the streets. You want to pick one. You can probably snipe out maybe you know, First Republic. There were some others. Let me actually pull up all their tickers here so I can go over them with you guys. But today we discussed what was it? Yeah, let me pull them up right here. Here we go. So it's First Republic. Then we have Western Alliance Bank Corporation, ticker symbol WAL, another bank that you could maybe compare a lot. You can see actually, actually, you know what? I should have day traded this one. My goodness. Wow. All right. I picked the wrong one to have fun with. But yeah, so this is another one that at its low point, let me just tell you, it was down 34%. And then we also have PACW, which is Pacific West, I believe it's called. Yeah, Pacific West Corporation. So this is one, yeah, this one was not the good one to trade. But this one actually is down a lot more today, down almost 40%. So if things calm down, actually I reversed my thought, my previous standpoint. This is the one you pick. If you think people went crazy, and you kind of think, and let's say you're right, assuming you're right, that people went crazy and it's going to be contained at SVB. Oh, this one, hands down. Because while this one is, I mean, the same thing could happen to this one, which is why, like, okay, it's no free lunch here, because you could be wrong, right? I wasn't comfortable with holding First Republic over the weekend. I could be wrong, or not wrong necessarily, but I could miss out on what's to come on Monday. If things calm down throughout this weekend and, you know, Monday comes around and people are like, okay, let's all, nothing happened, we're all fine. I would highly expect a very strong swing to the upside for companies like this, even this one. I mean, if we kind of look forward into the future, hindsight's 2020, but let's say in 2 years from now, oh, this is just a blip, a crazy moment, kind of like how that hedge fund blew up and took down Discovery and what was the other one? Whatever, the other media company that I can't remember for some reason. Paramount. Jeez, it took me forever. Because they were called CBS at the time. Then you know you're going to be like, oh, well, I bought this one. I have a yield on cost of like 8%, which actually earlier today, I think the yield on cost quoted by Google, because Google finally updated it, was like 4%. So you'll laugh all the way to the bank. It'll be a fun story to hold. Or the reverse. On Monday, things kind of progress a little bit to the worst, and you know the narrative really kind of breaks into these businesses, and you're going to be a little bit sad that you're holding them. So. But this is, you know, the times where you have to evaluate for yourselves in your investments. Okay, are people right or wrong about it? Now, this kind of brings me into another discussion, and also one of the purposes for having this call today, because I feel like, you know, it's good to have. I mean, that's what these communities are for, right? These communities, their purpose, right, their intent is to be a space to discuss ideas, to try to help each other think rationally and remove the noise, right? Not embrace the noise, remove the noise. And especially in times like this, I feel like retail is going to be very prone to succumb to noise, okay? So I know it's cliche, but keep in mind, try to evaluate your portfolio on a company by company basis and try to really understand what you own and think about how does this event affect your business? Is it going to destroy you, or is it just kind of like part of the story, part of the narrative, part of just life itself, and you're going to move past this? Your business is going to move past this. I know that's cliche, but even though we say that, oh, we're going to behave that way when things crash, blah, 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 and then things crash, and then people freak out, and they don't behave that way. It's the strangest thing. It's the darnest thing. Now, I do think, and I am a believer in this, that this community is a strange amalgamation of the abnormal person, right? What I mean by that is you guys are a gathering place for people who are not the normal person, not the average person. Because while I do see occasionally here and there, and that's perfectly normal if you're listening to this recording and that's how you're feeling right now, I want to assure you, that's perfectly normal. You're human and stuff. That's why I also want to say, really analyze it for yourself and try to understand yourself, because maybe, just maybe, most likely actually, you actually should focus on broadly diversified index funds and have a small portion to individual stocks, because maybe that helps your psychology. Because like the vast majority of the investing process is psychology. And even though you pick the right company, if you have the wrong psychology, you'll underperform, because you will, let's say you pick the right company, but you can't handle the volatility. So that's going to cause you to make mistakes, and that's going to cause you to do things you otherwise you probably shouldn't be doing. So you got to figure out what's the way that helps you kind of navigate that mental minefield, right? And because that's part of the game, that's part of the process. So again, purpose of this call and why I guess you could think about it as like a Sunday call, but almost like emergency. So I'm making it's not just for gold members, it's going to be for everyone. All right. So let's see, Kathy Woods vibes. He bought even more after that. What's this? Yeah. So I will say, for example, one case of this, and is, or what people are talking about in the chat right now. So, because people in the recording might not be able to see the chat. So, Kilroy Realty. So I did actually end up buying more today. You guys, I'm telling you now before any portfolio update or anything like that. And there was a joke, because in the holding company portfolio specifically is where I did all these purchases today. For anyone, just to be, I guess, clear about what I'm saying. So within the Capital Mindset Gold, I have a holding company portfolio. It's a brand new portfolio. It doesn't have any performance years beyond, I think like the very late 2021 is when the portfolio was started. So it's like kind of answering the question. You have Capital Mindset, etc. Okay, you don't have Alphabet, you don't have any of these companies. What are you going to pick now? You're starting all over. What are you going to pick now? And so it was basically building a portfolio throughout 2022 and seeing the performance. So the performance on that one, if I recall off the top of my head, to be more conservative in my, or more accurate in my estimation, because I don't have the number in front of me, is between 40 and 50% for last year. And then this year is still, even with everything happening right now, it's still pretty positive for this year-to-date performance. I forget what it is year-to-date though. So I'm not going to pretend to say a number there, but I just know it's positive to some degree. And one of the positions that I've been buying here and there after the monthly contributions, which I'll refrain from saying it in video, but some of you know what the monthly contributions are. But in this video, I'll refrain from saying it because it, more than likely is going to be a public video. This might end up being on YouTube. Is the like I always think about, what am I going to use these monthly contributions? Where am I going to put these monthly contributions into? And it always kind of stimulates that question. I have the monthly contributions to my personal holdings, et cetera, and all that. And then this one's kind of it's an experiment of sorts. And right now, I'll tell you, it has. You guys who actually see it whenever you want, you guys can see that it is a different makeup. It follows the same theme, okay? Because if you see the positions I add to the most in my personal holdings, they match what the holding company is doing, right? And the same company is the largest position in both entities, you could say, because I am the entity in the personal, it's under my name. And then my holding company is the entity, but I'm managing, both simultaneously. So the themes are very much the same because it's a reflection of what I think is good for my own personal, let's say, journey or whatever. Okay, so let's kind of talk about, just my additions to Kilroy. It was, pretty simple to explain. I looked at the business, I saw the decline today, and I felt as though, okay, well, has anything changed? Has anything that I have thought changed? And for me, it's fairly easy. You guys are aware, and you guys can see for yourselves, like the allocation to my personal Kilroy. Because it's come down. All right, Kilroy's getting beaten up, right? It's at, let me refresh it because I think it needs to refresh to the price for today. But yeah, okay, so it's down like 17.23%. So it's come down in percentage, mostly because it's actually come down in valuation. So what I'm thinking about doing for my personal, because I've already bought a decent chunk today for the holding company. Coming Monday, don't be surprised, tell you right now my thought process. I might actually put it back up to the same allocation it was before, which was a little bit in excess of 4%. And Essex Property Trust, another business I didn't buy today, but I also kind of want to buy. And I'm going to be upfront with you guys. We're not upfront, more like a reminder. 2023, I believe, is going to be a strong year for myself. You might say I hate REITs, and that's the point of the conversations I see with people having on a daily basis, right? I know that some of you don't like REITs, and some of you like REITs. So different asset classes, people are going to have different tastes for it. I think for me, for my personal self, 2023 is going to be a year of accumulation for REITs. We could still have a negative year like we had last year. Last year was a very bad year for REITs. This year might not be a fantastic year for REITs, but it should give me an opportunity to, when new capital comes in, I go, oh, where am I going to deploy? All right, let's deploy here. Now, as of today, right, other opportunities seem to be potentially coming up, which might take away my attention from REITs for a little bit, right? Because, I see some value in REITs, but that doesn't mean that, there are other valuable opportunities that might show up. And again, another reason for this call is recall that, what I've been saying this year, it's a boring year. There was nothing for me to buy. I've been saying in every Sunday call, pretty much, I'm like, yeah, I'm done with my core. There's nothing out there, really. I'm kind of just building out supporter positions because that's, at the end of the day, that's what Essex is. That's what Kilroy is. CRM even, but CRM we're going to see in the update, but CRM is now severely reduced. In the holding company, you guys already know that. It's actually completely gone in the holding company. I only hold the amount in my personal holdings, the ones that have a contract on them, which expired, I believe they expired today. Yeah, they expired today. So yeah, I just made out with some yield, which was fantastic. But the position is fairly, you would say, reduced in size. And then I deployed some of that capital today. For the holding company, I pretty much deployed it into KRC, which brought KRC up to now a pretty sizable, if you look at the personal holdings versus the holding company's holdings as a percentage, KRC is vastly different in one versus the other. Just so you're aware. Just woke up. Is Fabio coping on KRC again? Well, I wouldn't say coping. I'm using it as an example to where the stock price is going down, but it doesn't really faze me. Partially also because, what helps is its size within my overall, let's say, portfolio, right? Because that's the beauty of having a diversified portfolio, or that's one of the benefits. It's not so much, I'm going to pick 30 companies and every single one's going to do great. It's also, from a psychological perspective, a bit easier to digest if you have, all these different ideas. You got to be reasonable with it because it's kind of like an art. There's a balancing act. There's not a perfect answer for everyone, right? That, you just do this and it's just, you're great, fine, whatever. But it's a balancing act. And what is the right thing is depending on the person, and you figure it out for yourself. But having a diversified portfolio helps with the mentality of things. So if you're kind of seeing some lag in one position versus another, and it's really, it's not having a good year, it's maybe going to be a little bit easier for you to stomach and not sell at the wrong moment and kind of stick it out. So with some of these REITs, or not some of these REITs, some of these positions that maybe some of you have, and I don't know if you guys want to I won't say your name out in the recording. I'll keep it, for privacy, but we can talk about it, right? And I saw that there were some comments today about, I don't know what the person's positions were. And if you're listening to this recording, you know who you are. I don't know what the positions that you're invested in, but you do want to be very careful in moments like this not to panic. Do not panic. That's the worst thing you can do. This is the time where, if you remember, and I guarantee you probably said this to yourself or you said this to other people, when things get tough, when things are down, I'm not going to be that guy that's panic selling. I'm not going to be that guy that's selling into the fear and stuff like that. I'm going to be rational. Well, yeah, remember yourself saying that because everyone says it. That's why I'm mentioning it. Everyone says that they're that guy. Okay, now's your chance to show that you're that guy. There are businesses that actually are in trouble, okay? And then there are businesses that are not in trouble, all right? So let's kind of go over some businesses that might actually be in trouble. Well, all those regional banks, they actually might be in trouble, okay? Like First Republic, they actually might be, right? Now, we might have the conversation here and say, no, Fabio, they're not in trouble. It's scary right now to own it, but they're not in trouble, so I'm going to be buying it, all right? But really, they might actually be. So you are taking on that risk, and you will be rewarded. Like we said earlier in this call, you will be rewarded if the risk doesn't pan out. And you see how cheap some of them look. Some of them are very, very cheap. Let's go back to what was it? This one right here, PacWest Bancorp. This is dirt cheap. So if the risk is a nothing burger, well, there you go, right? Perfect example. I fully expect if it's a nothing burger, this one will do really well. But if there is something more to it, then yeah, you kind of entered into a trap. Now let's talk about Intel, right? So Intel's one, and I'm going to bring it up just because recent buy, and of course Kingdom's now a huge fan of it. Shout out to you, Kingdom. The business actually.
Hey. It's a wonderful business, bro.
It is a wonderful business, right? Well, let's not. I wouldn't go that far. It's not like oh my God, the best business ever. It's a good business. I wouldn't say call it wonderful. It's a good business, not a bad business. It's a good business, and I think now it's at an attractive price. There are other businesses, by the way. I'm just pointing out Intel just because Kingdom's here, and the joke is, for anyone who doesn't know the context, King was very bearish into, but he was waiting for a specific point, okay, which we all agreed with. I think no one in the community disagreed on this point. We wanted to see them be better capital allocated. We want to see Pat Gelsinger show us, I'm willing to make the tough decisions for the longer term. And Kingdom's specific metric was the cut of the dividend. That was his specific measure that he really wanted to see. And once they did that, now he's where he is today. He's on Team Intel. Which mine was at the beginning. I liked their change, and this is what I want to note or give credit to Intel. I love what they did when they changed the strategy of Mobileye. Okay, I was like, wow, because I hated the original plan, despised it, and then the seizure of buybacks. Okay, fair. The agreements with Brookfield, great, and then the icing on top, the final icing on top, which maybe some retail investors out there hate, was the cut of the dividend. That showed me everything. Pat Gelsinger is serious. He's really serious. He's kind of putting his reputation in. But anyways, so Meta was another company that today actually kind of was like, oh, bank crisis? Oh, I don't care. Which is kind of funny. We joke about it, but kind of funny too, right? Because Black Swan event potentially just started, right? Again, I'm hoping Monday comes and it's nothing, right? But potentially we could have just we're filming this video, we're talking in this call here, and we're talking at the very beginning of a Black Swan event, right? The beginning of like a cascading effect. And Meta was just like, yeah, whatever. But I guarantee you, if it is something really big, Meta's going to feel it too. Like we're going to feel it across the board. So if you're accumulating assets right now, happy day for you, right? Because my goodness, this could be wonderful. I think regardless, there's the appearance of some wonderful opportunities. I'm going to talk about another company I began to accumulate today. And that is International Continental Exchange. So I actually trimmed down a lot. I took actually a loss here. I realized the loss, and so I'm going to reduce that against my taxes. I know that, again, it's like kind of a meme now because of 2022. All the people making videos were doing that. But this is a company I trimmed today significantly and recognized a small loss and took that capital and put some of it into ICE, International Continental Exchange. Kind of built out a starter position. What I believe is, while this is cheap, right? Well, this is cheap. I believe I'm trading up for quality, and now ICE is kind of trading at that fair price for a fantastic business. Not fantastic price. So I'm not making it the same size as FIS, but it's kind of like I think it's going to be like a 1%er right now. If I were to do the math, 1%, kind of something like that. The other one that I'm kind of interested in and kind of sticking to the theme of what we're talking about here today is 3M. Okay, so let's talk about 3M. 3M, actually, I had this conversation with Strongman Personal Finance, who's a veteran, and Jay Nagy, another veteran. One thing that they kind of gave me as far as, insight into their opinion, their perspective, was that sometimes you have to be very careful with claims, right? And we'll see what comes out because it's going to go through the courts, etc. But what I found interesting, and it didn't really move too much, right? And some members, when I spoke about it today in the call, didn't even know this happened because I don't think it made too many headlines. But the Department of Defense actually came out and said, pretty much in disagreement with that, the earplugs caused the ineffectiveness of the earplugs caused the deafness for some of these veterans. And the thing is, it's very muddy here because it's very difficult to prove that, they were wearing it when they were supposed to, etc. And they were putting it on properly because it's not just like I just put them in barely at the entrance of my ear and then, now they just work. No, you got to put them on properly. You got to use them appropriately when you're supposed to use them, etc. And so it's going to be difficult either way, and still it's a huge question mark. But 3M is a great example of, okay, it's going to be polarizing to talk about from investors because there's the camp that says this is a trap. This is, this company's going to have a crazy amount of legal bills following the lawsuits. And then there's the other camp that says it's not going to be that bad. And if it's not that bad, you bet this company is going to be an interesting opportunity right now. There were multiple earplugs of various types given to us. So you see, that's something I didn't know. So under the context, to refrain from using name because of the public video and stuff. So what is your take on it? You can either say it verbally or you can type it. I want to hear your take on it. Do you think that this is an actual really big problem, or do you think it's being stretched? So from the only veteran I've spoken to so far, and it's only 2 people, told me their opinion, and one of them, I know for certain one of them actually saw combat and was using these plugs. So that was their opinion that they shared with me. If anyone wants to share their opinions as well, if you have the experience with these products, let me know. Paul's better. He bought $40 to $50 range. Oh, talking about Intel, buying Intel. Yeah. So yeah, enough said about Intel, but price is completely different now.
Sure. I agree with Strongman that we got tons of different earplugs. I don't know how you prove that the 3M ones did or didn't cause you hearing damage.
It's difficult, right?
I never used them either. I didn't use them. I used a different type. So and there was a mentality when you came back from deployment. Everyone just told you to go claim disabilities at the VA to get a check. So
that's exactly, I didn't want to say that, but that's what they told me.
Strongman probably said the same thing because we went through it too, both. But.
Yeah, so I don't know how the court's going to handle that, but that context, and again, what is, I don't know how you call it other than, okay, exciting from an investing perspective is that opinion kind of put out. I don't know if that helps them. That may not do anything, right? We don't know. At the end of the day, the courts are going to decide. But the Department of Defense coming out and saying what they said might turn something in the favor of 3M, right? I assume 3M has good lawyers, et cetera, and they're going to fight this tooth and nail. But that is something definitely. I think 3M reacted the day of but then kind of completely gave up those gains. So 3M is a company I'm looking to accumulate that. I find it funny. If you've been invested in the market for anything in excess of 5 years, you remember the time where 3M was considered the safe stock. It was incredible. Like just not too long ago. 3M, I mean, I can tell you basically, if you just take a look at the price, I can draw this narrative for you, but back in the olden days, back around here, oh my God, 2017, 3M, all the dividend growth investors were, 3M's a staple. Like you need to have 3M in your portfolio. Like you need this company. This company has 60. They would always say that 60,000 products that they sell. Today, actually, credit where credit is due for a lot of the dividend growth investors because some of them have kind of stuck to their guns here. And I think they're my opinion. I could be wrong, and I'm biased, right, for saying that because now is the time I'm buying 3M. They're buying more of it, right? Not all of them are saying, oh, now it's trash, but there's a lot of people who changed their tune once things got bad. Again, everyone says, oh, I'm that guy. When things get bad, I'm gonna realize that that's just noise, etc. There are moments when that's true. There's moments when that's very, very true. Here, you know what? Because I hate saying something without giving a real world example. Let me give a real world example. So Teva Pharmaceuticals. I can tell you, again, if you've been invested in the markets for a while, and I think my younger self was crazy, a little bit too crazy. I was paying attention to too many companies, and also keeping a pulse on like what retail was saying, so I could kind of get an idea of what these other investors were saying. And I can tell you for a fact, back in the day, Teva Pharmaceuticals, when it was crashing, retail was all over this. It was a value trap. Okay, so there were serious implications. There were serious problems. Now, what were the problems? Was debt, right? It takes time for these transformations to occur. I use Teva as kind of a dual example. If you've seen me in the calls or the Sunday calls, you know how I've graded Teva's management. Teva's management has done a good job. They've actually executed on their plan. Their share price is not reflecting that. I'm not saying they're a buy. I'm just talking about management said they would do X, and what they've done is they've gone to X. Okay, so that doesn't mean that the market's going to say, oh, tomorrow you're rewarded. Here you go. Here's a higher share price. But just as kind of like me as an investor, I take note of that. I say, okay, well, I know that management team, the one in Teva right now, they said that they were going to deleverage by a lot in 5 years. And okay, we're past 5 years now. How have they done? Oh, they've done a really good job. Okay, so now I can kind of trust management for when they say, and they say there's still a lot of work to be done. I believe them. Teva was one of the most leveraged generic drug companies. And actually, now that I think about it, Viatris is another generic drug company and also highly leveraged. Kind of like yeah, you know what? Because that was like 2015. Again, if you guys were invested in 2015, you might remember, or just take my word for it. Like, trust me, bro. Here, don't take my word for it. We'll actually use the chart to explain the story. So back in 2015, the generic drug companies, they were hyped up. They were the next thing, right? So they could do no wrong. Right around, you see 2015. See, they could do no wrong. It was crazy. And then fast forward to today. Look at this. You basically gave up all the gains. You're what back to. I think you hit $5 at one point. Maybe $6. Yeah, but you're kind of back to 1999 levels. You're below 2000 levels, which is crazy to think about. But they deserve it. Massive amounts of leverage kind of piled in here, and they destroyed the business. So, anyways, talking about other businesses, kind of in the spillover of this banking crisis. And again, if you guys, what is this? Why I'm buying 3M stock analysis 3 years ago. Oh, yeah. Thank you for, okay. So this is a YouTube video. JC made it his mission to prove my point. So thank you, JC, because this helps me to, prove the point. So this is a YouTube video from 3 years ago. And here you can see, again, 3 years. Let's see the date. Exactly January 31st, 2020. Why I'm buying 3M stock. So this is right before the pandemic. So right before the pandemic hits, this individual is saying, 3M is a great buy. I imagine none of the things they said is outlandish and out of the ordinary. 3M probably, I assume at some point they're going to say they have like 60,000 products or something like that. If they don't, I'll be very surprised that they don't mention that, because that's usually what's talked about. I'm trying to see, because it's usually maybe a highlight or something. Replacing approximately. No, it's not that. I'm not gonna watch the video, but tells me that it's, again, kind of like a trust me, bro. Trust me that it's talked about a lot. Okay, this is like talking about their what is this? Their dividend yield. So that's kind of crazy, because, all right, guys, let's what dividend yield is that? 3.56. It's near an all-time high. What is it now? Like a 6 almost. So yeah, you're getting it for double the yield. Yeah, nearly a 6. Look at the video recommendation, Strongman, on there about 3M earplugs. Where is it? I don't see it. I don't see it here, at least. Oh, right there. Oh, yeah. By the way, so Strongman actually replaced the thumbnail and title for me, because of the dividend will get cut. A dividend will get cut if the lawsuit's bad. All right, I disagree with that alone. Dividends just don't just get cut, right? That's not how things are. So the dividend will be cut if the litigation is bad. If the litigation is very bad, yes, the dividend is under threat. And that's, I think, what it's priced for. So that's kind of the play here. If the litigation isn't bad, or even if they win, oh my God, if they win. So that's when the dividend narrative goes out the water. All the present value of all the future cash flows is going to be much higher, because the future cash flows are going to be higher because you don't have litigation expense. So that'll all be a positive. So have we talked about REITs already? No, we have not really talked about REITs. I kind of mentioned them in passing. Yeah, you talked about it. It's recorded. Okay, so yeah, I talked about it in passing, not like dedicated to it. Okay, Heck told me. What time did this start? Okay, let's see the recording. It has been 47 minutes since we started the recording. Okay, so this is, again, I'm saying it one more time for anyone joining now. This recording, this session is kind of like as an emergency, just because we're seeing a crazy time. We're seeing a crazy moment, and I wanted to get something out here, have this conversation with you guys as kind of like a community. So what the heck happened to KRC? The only thing I can tell you, Jason, is spillover effect. Concerns about the spillover in the startup space from California with the collapse of SVB. So Silicon Valley Bank is one of the largest servicers and bank service providers to a lot of these startups. Their collapse has wider implications for the business environment in California. That's as far as I can ascertain, because really from the business perspective, I'll say it again, I said this earlier today, as long as KRC gets its rent, it's all good. But that's the question, as long as they get their rent. How exposed are they to that? I don't know. Fabio already gave us us buy and sell instructions. You already, yeah. Fabio, when I copy you, I want gains, not losses. Well, yeah, I mean, I wish it was that easy. First of all, just to comment on that real quick. I know, Kingdom is joking. He's obviously joking, but it would be fairly difficult to effectively copy. I'll say that. What means should not double down on Carvana? Jason, was it you that I was reading your comments all over the place today? I know you're joking and memeing a little bit. Maybe you're not. Maybe it's also because Carvana has actually rallied really strongly. But you've been talking a lot about Carvana. I find it hilarious. I have a buy order ready for BurgerFi. Oh my goodness, BurgerFi. BurgerFi might be the only company I've ever owned. Of course, it's not a real investment. It's a fun investment. But the only investment I might ever own that has gone bankrupt. Actually, no. Technically, I had one share of a penny stock for the lulz, because kind of more the novelty. They're bankrupt now, by the way. They're a shell company. This one. Yeah, look, it's sitting at $0. That's actually funny. So, wow. Hey guys, I can actually let's take Capital Mindset public. I just buy this for 1.5K. Let's go. Let's do it. We'll do a reverse merger here. But yeah, this was anyone. Wait, actually, I don't want to say. Does anyone? Don't look it up. This is the honor system. If you've already looked it up, don't answer the question. All right, honor system just for fun. What company is this stock known for? Honor system. I'm trusting you guys. eHarmony. Okay, no, not eHarmony. I'm not going to say that out loud, Kingdom. He didn't say something bad for the recording. He didn't say anything that bad. It's just, not for the recording. All right, so Dan puts a thinking face. No guesses? Okay. 1 Hour Energy, Blockbusters. All right, I'm very proud that people are, giving honest.
You didn't tell us what it was.
What?
You said, "What's this company known for?"
Yes.
But you didn't say what company it is, or.
Oh no, it's right here. You see it in the screen share.
Oh, I didn't realize we were on stream.
No, yeah, we're doing. So
Alias and Math. Oh, that's the movie theater.
There we go. Yeah, Movie Pass.
They were doing monthly subscriptions to watch movies and at theaters.
Absolute terrible business model.
It was a Wall Street Bets hot pick back in the day.
I can't imagine. No, absolutely hilarious case study. If you don't know that this company even existed in the past, they charged people $10 a month, and you could see as many movies as you wanted. I use them, and I am one of the people that definitely caused or helped or contributed to the bankruptcy of this business. I went to see a movie every single day in some weeks. It was nuts. I was like, all right, give me $10. Okay, I'll go to the theater and I will watch, every movie that came out, every new movie that came out.
Am I bankrupting Planet Fitness if I go use them every day and only pay $10 a month?
No, well, they bank on that most people. Planet Fitness, that's their model. They bank on most people won't go to the gym.
Well, it sounds like that's the same model then. They're banking on you not watching a fucking movie every day.
But the difference is, come on, exercising versus going and sitting down on a chair and watching a movie. I think most people would be like, yeah, I'll go watch a movie. But a lot of people would be like, I don't want to. I think there's this, I forgot the statistic, but I'm pretty sure it was only 20% of the population even works out. Something crazy like that. And by the way, I think the statistic goes further. It's only 2% of the population can bench 225. Is it 2% or 1%?
To be fair, 225 is kind of high.
No, yeah. But I'm saying so that's random factoids.
I would work out every day and still can't bench 225.
Bet if you really focused on chest, you could get there. But yeah, if you really focus on chest, you could probably get there. Well, I don't know what size you are.
Bro, that's 245 plates on each side.
Yes.
That's well above average, or well above what any athletic person can do.
Yeah, no, that's why it's 2%. But all right, so
especially when you count on women and young people.
Oh, the youngins, yeah.
Or old people.
All right, we have a question from Jason. Fabi, do you think institutions are selling REITs to get liquidity, which caused the REITs to melt down? Well, caution when you say institutions selling REITs, because it's not we're not talking okay, banks don't own stocks like that. They're custodians. More there are few entities that dabble in just buying and holding shares for ownership purposes, not custodial purposes. So you have Vanguard and BlackRock, which own a big portion of most businesses that are traded on the stock market, but they don't own them. They're custodians. They own it on behalf of others. And same thing with banks. When Merrill holds my shares or Charles Schwab holds my shares, they are technically the agent, right? They're holding it for me. So it's not directly under my name. It's under their name, and then it's in my account. So then it belongs to me. That's the relationship there. So it's not they're selling. Again, I would kind of almost argue KRC or other REITs. Specifically let's talk about Essex. I think Essex. I bet I could be wrong. Let's pull up MAA. I think MAA is kind of a softball. Yeah, that's a softball. So MAA, let's put Camden CPT. What is it? No, yeah, CPT. So Camden Property Trust, 3.5%. Essex got hit the hardest. Well, what's the common theme here? California. So what? Oh, sorry. All in regen. Do not even like. Okay, I don't know if you. If you don't know about this company, super quick. MoviePass. That was MoviePass. They're gone. So if you don't know about MoviePass, read up on it. Great case study. Tons of videos actually on YouTube. Just a good, just to get your mind thinking about terrible business models and what not to do, but kind of have entertainment. I think EQC is going to.
Zoom out on it and see if you can guess when it was the hot Wall Street bets pack.
Okay, let's get right back to it. MHMNY, and I'll go the 5-year.
I think it was more than 5 years ago, though. It was probably about 5 years ago, but I can't remember.
The thing is, it's difficult. It wasn't 5,000 back then, but yeah, all the reverse stock splits they did.
Yeah, it was like $35 when it was a Wall Street bets play, and it probably was 2017.
Jeez, yeah. Back in the olden days. I think EQC is going to look to acquire one of these REITs if they keep falling. Well, that's what they're set up for. I really don't like that management went the special dividend route, personally. That's a disagreement. I think some of the analysts, if you listen to the call, were a bit disgruntled, kind of the management's admission that they don't know what to do with the money. Which is, okay, that's a fair, I guess, admission, be honest, but just because there wasn't any good opportunity doesn't mean there won't come about one. And I think actually buying up the commons or buying up an entire REIT might actually be a good decision if I had their ear, right? If I had the ability for them to listen to my opinion, if I was consulting them here, I would actually kind of push them away from trying to acquire in the private space. Why go about that? Why not just buy up an entire REIT out there? Now, granted, your options are limited because the best ones that I would want to acquire, they don't even have enough cash for it. So, forget about it. And you're already inheriting a decent amount of leverage when you buy, let's say, a REIT outright. Let's say you merge, right? So, well, they could actually structure it in a different way. They could more do like a merger, like I just said, not really a full out acquisition. But that being said, like REITs are trading at almost across the board at significant discounts to NAV, and even some are below book, right? So why would you want to buy the real estate? Just buy the common stock. It's like, what are you doing? Again, we were talking about KRC just now, but KRC is trading up below book, so that that's not the net NAV, and the NAV, they're not really, the market's not in a position for them to actually realize the NAV, the current NAV. So think about it, let's call it fake NAV. Even if you give it that NAV a discount, right? Let's say they can only sell it for what they hold it at book value, right? That's very conservative. That's very, very conservative. Well, yeah, they're already below that. They're significantly below that. Just kind of to reiterate that there's a severe panic in the office space. I am not, and I said this in the voice call earlier today, I am not thinking, if you're wondering, of making KRC a meta-sized position. It is, at the end of the day, while it can be a core holding, it's like a core supporter, right? It plays a theme that I like. It's a deep, let's say, value play. It is a value play, but it's not something that I'm like, I know I'm right? I don't have that feeling with KRC. I really do think I am right. All right. It's not that I have low confidence or whatever, but I don't have like the extreme conviction. So let's talk. Oh my gosh. Okay. If you're watching live, if you're not looking at the chat, look at the chat right now. That picture is hilarious. It cracks me up all the time. I'm not showing it to the recording because some people might, I don't know, they might take offense to it. That it has so many layers to the joke, because that makes me die. That makes you die. And the whose profile picture over there on the right is just, it gets me. Oh my gosh. That's amazing. Okay, so I believe KRC has an AFFO payout ratio of 60-ish%. I really don't get why it dropped so fast. Jason, in all honesty, the rationale that I can only point to, I'm trying to show you also with Essex, is California. So California is the common theme here. If you are a California-based whatever right now, the biggest iconic bank of California just died today. And maybe, just maybe, some of the tenants are related or working for the businesses that are related or were doing business with that bank that just died today. So why Essex? Well, Essex has a lot of tech employees. Well, a lot of startups, a lot of these employees, maybe they work for these businesses that had a strong banking relationship with a bank that just died today. Like, let's remember that. A big bank. It's not like an itty little tiny nano cap. It's not like Quaint Oak Bank that we talk about sometimes. Well, this is a regional bank. It died today. It's dead. It's gone. It's going to restructure, right? The equity holders, they're wiped out. That just happened, boom, in a day. So the market still needs to adjust this. In the moment, there's going to be the panic. So 6.7% drawdown in Essex. Okay, I can see it. I can kind of understand why. Now, broadly speaking, of course, Essex kind of dragged down the other players adjacent, like Camden, etc. But maybe there's a fear like this could be continued. This could be the black swan event that starts things kind of rolling down in that direction. Yeah, could be. I don't know. It's all right. So we see it's a very good idea. Yeah. So I agree with that. So what do you think about SIVP, Contagion, just a bunch of degens, VC land? So no, in fact, actually, Gundar, just to repeat a little bit what I said, and just in case people didn't get this point from you're watching the recording, they didn't do anything degenerate whatsoever. But I think you probably mean the degenerates were the people trying to take the money out all at once, which, yeah, that is the case. That's 100% the case. The bank did everything right, actually. The bank had a pretty good book, all things considered. And what just happened is everyone wanted to take out the money, and they couldn't sell the assets at a good price. The yields are much higher. A lot of the bonds they hold are valued less right now. They're selling at... They had all these unrealized losses. And, that's all well and good. It's unrealized. We're not going to... let's say, sell. I'm not going to sell at the low price. I'm going to hold it to maturity and get all my money back and then my interest, right? That's great if you have that option. But they didn't get that option in this moment. This rare moment, they had to start realizing a lot of those losses. They didn't have the liquidity. So it's a liquidity issue. It's quite literally a liquidity crunch. This is it. Liquidity crunch, liquidity crisis. This was on a micro scale. Absolutely destroyed them. So let's see here. I just think VC land is full of degens and the bank is in VC land. Fair enough. What was I going to say with this? Because there was another point to...
Really quick question, Fabio.
Mm-hmm.
Because I haven't been able to follow this closely. Didn't you think that the way that they, weren't they buying kind of longer duration treasuries? And isn't that kind of, because wasn't that the problem is that they had a bunch of losses on the treasuries that they were holding?
Yes. Yeah, that's what, so earlier in the call, that's what we basically all talked about was what happened is the duration issue. So anyone watching the recording, if you missed it or you skipped over to this part of the video and you're listening to this and you're like, that was in the first 20 minutes. But just to reiterate it, because I guess to draw out more points or to emphasize the point even more, what Gunnar's saying is, again, exactly the case. So they didn't do anything wrong, and this is, again, just hammering this point again. If you ever hear someone say, I don't understand why the government just doesn't borrow at the 30-year, if they did that, they would starve the system of very much needed liquidity. You be very careful what you ask for. You would cause a lot of problems, even though you think that's intelligent. But
just my follow-up question was, did you know what because I don't, what kind of duration they had on these treasuries they were holding? Were they I wasn't sure if they were holding a crap load of long duration that was kind of degen, or if it was just like they had kind of normal bank, like kind of laddered out maturities, and everyone just ran on the bank essentially.
Well, I'll say this: there too, put up a beautiful, beautiful chart that illustrates this point. Everyone check out chat right now and pull up that chart for yourselves. Look who's at the top and look how much of their portfolio was in excess of 5 years. So let me pull this up for people watching the recording, but everyone who's watching live, check it out. And I think this illustrates the point very beautifully.
Can you comment on like Bank of America? They're number 3 on the list.
Oh yeah, we're gonna have to talk about that.
There's a few others. So.
All right, let's see. I hope it's not too blurry, but I'll try to remedy the blurriness for anyone watching the recording, because that's the best I could do in terms of zooming in. So look at that. At the top, you had SVB Financial with an excess of 5 years, 47.50. So illustrating the point, so much of their portfolio was in long duration. Again, it could have been great. It could have been great investment. They did everything good on the underwriting, everything. They did not think about liquidity, maintaining liquidity. And so here they are. Now they're dead. Now, Bank of America, look at that. He's right, being number 4. It's sitting at 23-ish%, right? So even for me, it's too blurry. It looks like it's 23.88%, but I see it as 23 for sure. I know that. So we look at under the 1 year, they have, what is that? 0.97%, if I'm reading that correctly, 0.97%. And then you have 3.12% sitting at 1 to 5 year. So I think, yeah. I mean, like it's cause for concern, but it's a different situation than having half of your portfolio. Now, 23% being also number 4, it sounds like a lot, but on average, I think I haven't seen and banks. I mean, even here, we're kind of seeing the point, or we're kind of seeing this kind of what I'm about to say play out. I don't really see too much banks having an excess of 30% in long duration. And here, let's go back.
5 years are also an issue as well.
The what? The 1 to 5 years?
The 1 to 5 years are also down like 10% as well.
Yeah. So down, you're saying yes. And if they had to sell those today,
the longer than 5 years are down probably like 20%, and then the 1 to 5 years are down like 10% in terms of value.
Yes.
Well, also you have to. I think the actual, like, if you wanted to break into this, I think breaking out and getting more detail on that 1 to 5 year is a massive deal. Like, difference between an 18-month like treasury and a 4-year treasury is pretty massive, I think, in this case. But like, because that 18-month isn't going to move much compared to like a 4-year or like a 5-year.
Oh yeah.
Correct. And just for anyone watching the recording to kind of get up to speed, so why is this an issue? The longer the duration of a debt, of a bond, the more sensitive it becomes to changes in interest rates. So if let's say you are SVB Financial Group and you have 47% in excess of 5 years. Let's say you can kind of see this if you create a PV function, present value function, and you try out, you change up the number of periods. You change the end variable.
It's easier just to look at TLT, which is a 20-year chart for treasuries, 20-year treasury chart, and then look at VGSH or something, which is...
Let's do that.
VGSH versus TLT.
All right, so let's pull them up. Actually, let's put them together right here. So as of late, guys, you should have seen TLT where it ran up. You can actually see right there, but it ran up quite a bit today, 3.48%, and you can see that Vanguard's short-term duration only went up 0.56%. But
and the short-term one is, I think, 1 to 3 years versus 20 years on TLT.
Thank you. Yeah, 25 on TLT, but yeah.
TLT is 20.
It's 20? I thought it was 25 when I read it last.
It says 20 on the name. iShares 20 plus. Oh, okay, 20 plus.
Yeah, 20 plus. But if you look at the average duration, they target 25. I think we read that in the prospectus in one of the calls. So with what you're seeing here in the 1 year, everyone watching the recording, you can see that, well, we know we went through a year where interest rates rose quite a bit, and you can see the decline you experienced in share price was only 3.33%, which is basically nothing, and TLT you experienced a 21.73% decline. So just showing you a real world example illustrating the sensitivity of bonds to rates. So longer duration, more sensitivity. So going back to the image, right here, if your portfolio is almost 50% in excess of that 5-year duration, you're going to be highly susceptible to changes and fluctuations in interest rates. That goes along for everyone, down the list. That side of their portfolio has that risk. Now, you have the risk of payment, right? That's a separate risk. Your underwriting skills come into play, et cetera. And if you're conservative underwriting skills, great, good for you. But that's only the case. It's only not an issue if you don't have a sudden need to liquidate. Because, all of us can say, think about it like for yourself, right? You have your stock portfolio and it goes down 50%. But you're young, you don't need to retire, you got nothing happening, you keep it. And then the stock market recovers and you're fine. It's like nothing happened. But now let's change up that scenario. We go through a stock market crash and you retired like last year, and you already you need to sell your stock portfolio to pay your bills, right? You are in that situation where and you didn't prepare enough because let's say you didn't have any cash savings, etc. It was all invested in the stock market, all of it, right? Because you could argue stocks are meant to be viewed as a long duration investment instrument. You're supposed to think about it, I'm investing in the long term, blah, blah, blah. It's not the same as cash. Cash is your short-term instrument, your short-term tool. And you could say, you should have, when you're about to retire, a decent amount in treasury bills, right? Short duration treasury bills, maybe 3 year, maybe max, maybe on the 5 year if you're going to retire, maybe 5 years, I don't know. But point is, you kind of focus on that, and you were a bit degenerate, even though, there's nothing truly degenerate. Maybe you were investing in very safe stocks. Who knows? You were investing in the index fund. Who knows? Point being, you were invested in the wrong type of asset, and your circumstance forces you to liquidate. That's what's happened with SVB here. And kind of answering the question there, going down, I'm not too concerned really with Bank of America at 23%. That's not too crazy. I normally don't see. I'm actually surprised. Well, no, Prosperity. Yeah, is that Prosperity Bank shares? Yeah, but I'm very surprised though. 36%. That's pretty high. I am really surprised though that Bank of America has such a low amount, 0.97%. Let's go down the list because Truist is at 1.57 and 20% on the long. Let me see where Wells Fargo sits at. They're like at rank 17. Look at that, 2.65% on the short, but that's nothing to State Street's different. Let me go down the list. Bank of New York Mellon's also different. They're not really that traditional bank. Trying to see who has the high. Was Wells Fargo at the highest? My man, I think. Oh no, Fifth Third. Fifth Third's at like a 3, and then we have BOK. BOK is at 3.32. And then we have First Interstate Bank System 3.92. Oh no, who's it right there? Commerce Bank. 4.48. I remember Commerce Bank. They're like up in Virginia. Oh, but point being, I'm not too concerned with Bank of America. I think that's fairly fine. Where's JP Morgan Chase? I might have not read their name. They're somewhere maybe. Oh, there they are. 40. No, yeah, they got 3.98%. Yeah, JP Morgan Chase. My goodness. Yeah, you see, like they're really. I know that Bank of America is that's probably so much into a lot of long-term corporate lending. They're really big in energy. I wonder if that's, but I'm not too concerned about that, unless we have a really bad. Yeah, I'm not too concerned. And they're a primary dealer too. I'm not too concerned about that one. I am more concerned about the guys around them, though. Commerce. It depends also. It depends really who they're with. First Interstate Bank Systems. Honestly, great chart, though. All right, we got a question. You need to stop trashing Citi. Look, they are good. Where is Citi? No, because Citi has a lot of counterparty risk. A lot of unknowns in there. Where's Citi? Can you tell me what rank they are? Are they like towards the bottom? Oh yeah, they're towards the bottom. But again, this is not the end all be all. So this is not book quality. So I want to remind everyone, this is not a measure of book quality. This is a measure of the specific scenario. This is more liquidity. This is a measure of liquidity, not book quality. So, and liquidity is a non-issue when rates are coming down. That's a non-issue. They can sell all those assets at a gain, if anything. So if we see kind of like a reversion of rates kind of back down in the later half of this year, that should help out with kind of like the ability for these entities to liquidate some of these assets at favorable, if not break-even prices. But definitely not right now. Right now, that you're going to be caught with your pants off. Yeah, so Citigroup being down here, just to answer Jason's question, because he's saying you need to stop. Remember, not a measure of quality, more of a measure of liquidity. And that's all we're looking at here. So, Lecker Lads asking, I'm European, so I just woke up. What does this list imply? So this list is just an implication of liquidity. You can see here, just to explain, I know it's blurry, so I apologize for that, but SVB, the company that went bankrupt, you can see that very small amount in the less than 1 year duration, 7% in the 1 to 5 year duration, and in excess of 5 year duration is 47.50. Basically, what you can gather very quickly, very quick explanation, very illiquid. A lot of those aren't maturing, so they're going to have to sell them, and high sensitivity to interest rates. So they're selling them in a terrible time. If we were in a declining rate environment, and you're going to hear this a lot too, so people who ascribe to that, the Fed is the end all be all, the most powerful entity, the one that controls all the rates, etc. They're going to blame the Fed for this. They're going to say, well, the Fed technically caused this, right? Because they pushed interest rates up, and because they pushed interest rates up, then they actually put banks in a very awkward situation where they're gonna and there is there is something to be said about that because this is something I was hearing, and I agree with like the logic flow makes sense. So in order to kind of cool off inflation, we need to prevent this mass lending, and banks were still very comfortable with lending. So kind of tightening financial conditions, we have to somehow make them less comfortable with lending. Well, yeah, something like this right now would do it. Actually, this just came to me in my thoughts. I think this is more of the obvious. This event, I think, is going to have massive, ripples. And we're probably going to see, remember that conversation we had? I forget what call it was, but we had a conversation. I mentioned it in the Last Cents live stream as well, the private live streams. And I mentioned the definitely many calls, like the plateauing of credit growth. So credit growth rate of change, not in absolute terms. In absolute terms, it continued to grow, but the rate of change of credit growth plateaued in about, it plateaued in about July of 2022. This event, I'm really thinking this is going to have a strong change in behavior in terms of lending practices. I think now,
the change will be increase FDIC, like double it to maybe 500K or something like that.
That doesn't really change this. Now, I'm talking about from the perspective of lenders. They don't want to be caught with their pants off. The FDIC insurance doesn't protect them. It protects you, and it doesn't protect the, let's say, like I think the number, for example, with SVB is only 150 billion fall under that. First of all, for that. Like it's not even that much. Sorry, 50 billion of the 200 billion, only 150 was uninsured, because it falls
most
off.
of it's not insured.
Yeah, like FDIC insurance, in this case, didn't really help, because I can tell you for the experience I have.
90% of it was uninsured.
What?
Yeah,
Which would be
Like,
180 billion uninsured.
180, some number. I forget where we read it
Very
from.
high, it's like 90% or something. But that's just from comments. I was reading it.
So the point there, right? If most of it's uninsured, I mean, yeah, you make the argument you should double it. What is that? Now that's 500K. Most of the entities that had accounts here, they had really big accounts. Like I was looking at statements with a lot of the accounts are having in excess of like 100 million. And so what good is 250 to 5? Oh, thank you. Oh, that
All right,
helps.
well, make it
this will keep
unlimited.
pennies.
FDIC unlimited.
That would be a wonderful thing to do, but the thing is, this is the we get into a very funny quagmire here or awkward situation because the federal government doesn't have the capital to actually insure the entire banking system. I forget actually how much the reserves are for the FDIC, like how much they have in terms of dry powder, and then everything else is to be borrowed. But the thing is,
Yeah, we can just print it. Cause hyperinflation.
no, but they can't print because that's not how the system's set up. They have to borrow it all.
Oh, not this again.
But they can't. They cannot print. They have to borrow it. So, but who do they borrow it from? the very it would cause like that would be Armageddon. That would be financial Armageddon because think about map that out in your mind for a second. The plumbing. Map out the plumbing there, right? So you have the FDIC. Let's assume we have a scenario. Crazy scenario. We have Lebanon, but in the United States. Everyone rushes to the banks. All the banks collapsing right in front of you. The FDIC ain't gonna do anything. That's something that you have in the good times, right? That maybe can cover one or two, but not something where if we see a scenario where like Wells Fargo, JP Morgan, they're collapsing. Let's just imagine it. I know it's hard to imagine, but let's just imagine it. There isn't anything that can be done there. That will be such a dramatic. There will be other things to worry about besides their stock price. Their stock prices, that's going to be maybe the last thing you're worrying about. You're going to be worrying about other things. So you can make the argument. That's again why they almost like they can't afford to allow certain things to fail. Right? Is the arguments they're going to make because I mean, fortunately, that's the case because the money that the federal government receives when it borrows is not coming. It doesn't come from the Fed. There's no other way to say it. It doesn't come from the Fed. It relies itself on the financial institutions that make up the big banks. But that's where it all comes from. There's no other way around it. We can change the system.
You just went on a really long rant to agree with me that they have to unlimited FDIC insurance.
They have to unlimited FDIC insurance?
Well, I mean, they're basically making it unlimited as it is for the big banks because those bail them out and they will never reach the FDIC thing.
Well, let me kind of get into that because bailing out assumes that there's no. There's equity holders. You're wiped out. There is value extraction from another place. Like you can't sit there and say, for example, Citigroup got bailed out. The equity holders, there's nothing. No, you got wiped out. You got effed, right? There is a loser. The loser is the person who took on the risk, the owner of the business. The owner of the business, gone. You're done. You're out of the game, right? The government doesn't just say, you did this, your company messed up, and we're bailing you out. No, it's not like a real bailout, right? That's maybe it's more of a misuse.
2000 bailouts where it's not really like direct bailouts, 2020 bailouts where they just print a shit ton of money and lower interest rates.
But they didn't print money. They spent a lot of money. They give out a lot of PPP loans, etc. There's not printing. It's not printing, but I know what you're saying. A lot of fiscal spending. They did a lot of fiscal spending to try to stimulate, to try to jolt the economy, to counteract the lockdowns that they did. And yeah, all well and good, right? So in a way, that's an indirect bailout, sure, because inherently any stimulus to the economy is in a way bailout to the banks, because the banks are directly affected by what's going on in the economy. We can all understand that. It's like it's an overused word, but it's a toll road on the economy. one way, this is actually, common saying, if you want to invest in the economy of X country, you invest in a good solid bank in that country. And you should kind of generate or eke out like a return based off of the growth of the economy of that country, if it's a good solid bank, right? So again, toll road of the economy. If you stimulate the road, of course you're going to help the toll road. That makes sense. Like, 'cause you're basically inputting something that generates more traffic. Of course they're going to benefit. That makes sense. You could say, almost the same argument by stimulating consumer spending. You're bailing out Visa. You're bailing out MasterCard. Even though you're not giving them money directly, you're bailing out. You're technically bailing out the consumer, and then therefore. So it's like saying, if I bail out the bank, am I bailing out the people borrowing money from the bank? And not really, right? I wouldn't say that. No one here would probably say that. But when you bail out the bank, you're allowing the bank to then continue to conduct commerce and lending, et cetera. And so I can use my credit card because the bank's still around, and I can borrow money from them to get a car, et cetera, because the bank's still around. But you wouldn't say that the government's bailing me out, right? But even when we say the word bailout for the banks, it's not at all like Citigroup got bailed out and there's no consequence, or Bank of America got bailed out, there's no consequence. No, equity holders got wiped out. Here, if there is a bailout, it doesn't matter. You own the stock, you're done. Value's gone. They're going to pick up the pieces, and the entity will survive to some fashion or something like that. But it's not like an infinite energy source came in and inputted energy. It's more like, okay, energy was completely extracted out of the shareholder base, gone. You're done. And then they shored up. They provided extra liquidity at the sacrifice of the shareholder base. So, because for example, a lot of what happened was they issued a bunch of shares, right? They raised capital, and then the bailout per se was providing that liquidity on the other end of things. And that's not, again, we're being technical, that's not really a bailout. A bailout is like, let's use an example. There too, you were out, having fun, you did some bad stuff, you ended up in jail, and I come in because I'm we're buddies and stuff, and so I bail you out. I pay for your bill, and now you're out of jail, right? You're fine, and no consequence. I don't charge you anything. I just bail you out, right? Something that you might use the word for, like I don't know, a son, a friend, etc. But anyways, will the Fed stop here or more pain to come? It doesn't really matter what they do, because depending on how you look at it, either way you kind of get to the same conclusion. But if you recall, Jason, from all the calls, you can look at them in the archive. All the calls we've talked about, the destiny of the Fed was written already, and the Fed just doesn't want to admit it, but it's already written. The liquidity crunch of last year still has kind of growing pains. We have a joke about it, phase 2, etc. I had no idea, this is SVB Financial would blow up. I had no idea that, it is a meme at the end of the day. It's a joke. The joke has funniness to it, and it's funny if it works out the way it does. And the second part of the meme, or but I do think that the Fed is now, at least whatever camp you're on. If you're in camp Fed doesn't matter, or Fed is the god emperor of the economy, both camps are probably in agreement now that there's a tone change that is going to happen. I am now probably, adjusting my opinion, much more concerned about lending patterns, how this event is going to affect that, because I can tell you right now, if we see the rate of change go from flat that we witnessed in July and the second half of last year, if we see that dip into the negative, and just to kind of reference a live stream we had back in November, it was the one where I talked about Kathy Wood's economic prediction. But I spoke about my thoughts on the holiday season, that the holiday season would come in relatively strong because the absolute value, the absolute growth in nominal terms of lending was still on the rise. And we were only seeing the beginnings, the cusps, in some cases, of contraction. This might have been the catalyst that causes a reversal of that. And that can be very scary. Okay, I'm actually genuinely a little bit worried about the speed at which things can change, because if you're thinking about if you're a lending institution and you see that, well, this guy just got absolutely wiped out. Well, now I'm not. Oh man, I don't know if I want to. I don't know if I want to lend right now. I kind of want to shore up liquidity just in case. I'm not going to make that loan now. Oh, I'm not gonna do that. Start thinking about that. What ripple effects might that have? And that takes time, right? That puts us right in line. Very interesting timing to probably tail end of 2023. Tail end of 2023. That's kind of where that would put us into kind of witnessing those effects. Not too dissimilar from the bond market. I mean, it's kind of funny. Like, did the bond market predict this? I don't know, but like. We've been in very strong sustained inversion. We've been in an inversion in markets that you haven't seen, this kind of behavior. Like the bunds, like this is wild stuff right now. So, you have to pay attention to the severity of inversion and duration of inversion, and both of those are pretty severe. Both of those are pretty strong right now. So, we would be the abnormal moment in history if we don't have some recession now. This is the exception. This would be the exception. So
Can you comment on junk bonds real quick?
Sorry,
junk bonds went down today, while obviously bonds went up today because rates went down, and but junk bonds, they're still kind of in the toilet.
Well, that makes sense. No, if you didn't know that, junk bonds.
I mean, I'm not surprised by it, but I'm just trying to get it's a nice topic.
Oh, okay. So for the okay. So for anyone listening, so the reason why, I mean, intuitively, you'd say, okay, yields coming down. That means all bonds, right? All yields, right? No. Because there's a separation we need to fix first. So first, we need to understand that not all bonds are created equal. Even high quality corporates can mimic the same behaviors that we'll see at the pristine collateral. When I say the words pristine collateral, I want everyone watching this video, wherever you're watching this from, to think, okay, government debt specifically, typically people are talking about U.S. government debt. We're not talking about Lebanese bonds and German bunds. And, you could throw in Japanese bonds as well. You get the picture. Very high quality, very pristine, very high credit rating countries. And these are as much investments, like I said earlier in the call, as they are tools. So you have the tool aspect of the bond used to settle transactions between entities, and also can be used to generate some extra yield. But if you're seeing some negative yielding bonds and you're wondering who on earth is buying this, it's because it's more than just an investment, it's also a tool. So just keep that in mind. Okay, second to that, we're getting into why not all bonds are created equal. So bonds in a stressful environment, right? When we have a recessionary fear, you should see a escape from risk assets to less risk assets. That, like I said, tends to be pristine collateral. Now, junk bonds do not classify as that pristine collateral, right? As we kind of were just discussing. Well, the word junk bond should scream out. The word junk should jump out to you. So almost the complete opposite of what should come to mind when you think pristine collateral. And if you think we're entering a difficult time, are you looking to deploy capital in the debt of an entity that creditors consider to be junk? Probably not. You're looking to jump into the word pristine collateral. So you should, when yields are coming down in this moment of uncertainty, I would never expect, and so none of you watching this recording should ever expect to seek out safety in just any bond. You shouldn't see actually outperformance there. Rule of thumb, when you think we're going to enter some moment of great uncertainty, you look out and you look at that pristine collateral. That's where you should be kind of deploying. Remember, we're talking about, if you're watching this from Sense, recall the write-up I did, the macro write-up, that when we saw yields kind of rise, it was a good opportunity to accumulate some of those assets. I was going to do a write-up, and I'm thinking now I just kind of link this to, and if you're watching this recording from the portal, I was originally going to do that write-up, but now I'm just going to probably just link this video because I think it does a good job at giving you a lot of content. We're at an hour and 30 minutes, but gets you all the ideas and And also, I love having people on here because, like what There Too said, he brought up this point that maybe some people are going to be interested in and provides value, hopefully, to some of you. But anyways, so junk bonds makes a lot of sense that you do not see a rally. While let me pull up the TLT, just TLT by itself. You see a nice little rally today of 3.45%, almost 4%. So flight to safety, and if you think recession is going to be pretty bad, expect actually a stronger rally. Let me kind of show everyone, if you're kind of new to the markets, what happened in 2020, March of 2020. You actually saw a very strong rally. Let me actually go more towards the February. We already knew about the virus and the uncertainty started to pile in. You saw a 14% jump, almost, I think from the lows here it was like 20, but it was like 18% from here to there at the very peak, 18.19%. So great, right? You're talking about bonds here. In such a short amount of time, you see that. Okay, so we got a comment here from Ross Gerber, the Albert Einstein of our time. For example, you can keep 100K in the bank. Jamie Dimon invests your money and takes all the profit. Meanwhile, inflation costs 7K or about $590 per month. This is a good time to add to your financials. We did in GK. We added Charles Schwab. That's a good one. And SIVB. What the fuck? We won't own the big banks. Okay, so comment real quick. Charles Schwab is still a money center bank. So weird he said the second part. And it's kind of comedic relief that he bought SIVB. Classic Ross Gerber fashion. I don't agree with the rest of what he's saying. No, now Charles Schwab, it is a bank, but it's not like what you think about when you think bank. But the other parts of what he's saying, JP Morgan Chase doesn't offer a lot of yield, neither does Bank of America, neither does Wells Fargo, because they have too much. There's too many deposits. They almost like don't want deposits. So you can kind of think about when a bank is offering more deposits, or more interest on deposits. It's because the demand, they want more. They want more. That's why they're trying to entice you to deposit there. Saying, oh, your savings, we'll offer you 4%. That's not for no reason. They're not your friend. They don't like you. They want your money. And why do they want your money? Start to think about those things, right? Say, okay, they probably want my money for some reason. Well, maybe they're trying to shore up their liquidity. Maybe they're trying to get more cash. And because, for example, let's take the likes of a SoFi or Ally Bank. These traditionally, you think of higher interest savings accounts. Well, what are they investing in? What does their book look like? We looked at this chart here, and yeah, you got the liquidity measure, but what about quality of book, right? If you have a low quality book, you're going to want to shore up a decent amount of reserves, just in case. And the likes of SoFi, we got basically what? Student loans and personal loans. Terrible and terrible, right? Both terrible. Student loans less terrible. Personal loans even more terrible. I found it comedic listening to someone out there, remain unnamed, who said, oh, the student loan's not getting paid off. That's fine because we're doing so great in the personal loans. Like, my guy, you're literally, it's just flying right over your head, and you're not understanding that you are buying one of the most degenerate banks out there. Like, you couldn't pick a more degenerate bank than SoFi. They're more degenerate than Credit Acceptance Corp, and that's kind of saying something. Maybe I redact that. Maybe they're more neck and neck in terms of degeneracy. Credit Acceptance Corp just ran really well, but the loan types are quite degenerate, because at least with the car loans you have collateral. You have the car, right? At least you can repo the car. Personal loan, oh my goodness, like what are you doing there? But anyways, we have a comment here. What is this? This is more comedic relief. Watching this video means probably the bottom is near with SoFi. Maybe if you believe it's undervalued. Oh, that was 8 months ago. That's very funny. That is very, very funny. Oh my gosh. But yeah. Just kind of getting back to the bond commentary. If you're thinking about, bonds are still maybe like a good entry. Again, if you think we're going to have severe recession, there's other investments you could make that are proxies to a lower interest rate environment that we should still do well. I kind of want to say, like, again, just saying. But the thing is, more pain that it's not a direct beneficiary like you would see with something like a TLT, more of an indirect beneficiary and going to have a lagging benefit. So that would be more like your REITs there. But instant benefit would definitely be your bond instruments. The meme, for anyone who doesn't know, and again, just be very cautious about, because not only you're going to have to be right, but right on timing, is a TMF. I almost hesitate to mention that instrument, but that is an instrument that if you're right on the timing, you're going to really capture the move on bonds really powerfully, but be very, very careful with that. And we've discussed this in Sunday calls, the risks. So I'm going to make sure I discuss them here because I mentioned the name, and there's no script in front of me. So if I do something and I'm aware, like, oh, I should mention this, I have to do it. So TMF, you will experience negative returns if it's flat. So if yields are flat, you're screwed. You will experience negative returns. You basically only win on the timing of the increase. And if it is flat and then just experiences all its gains at the end of the year, you are still probably not going to be that well off. So again, let me say that one more time. If you use an instrument that is triple leveraged to capture an idea, a concept, you have to be right on the idea and the timing, both at the same time. So let's see if the more questions coming in here. Okay, so you see the stock mode telling people to DCF into TMF. That's terrible. Yeah, no, that's terrible. That can end so, because you can be right on the idea, but if you're wrong on the timing, you're done. And DCF, that's terrifying. My friend is in it and he's been buying it like crazy. Yeah, but it's sad because something like today might reinforce that they're right and might cause them to double down on something they don't quite understand that they own, which could be very bad.
Yeah, so here's another point. The Fed will push rates until something breaks. This is something breaking, what we've seen today. So are they done with raising rates?
Yeah, I mean, I don't really care too much for deciding what the Fed's going to do. I just think they're a follower, not a leader. It is yet again I'm just going to come out and say it like it is, but the Fed doesn't matter as much as people say. What I mean by that is there are perhaps much better indicators as to, like, well, you can find indicators that are going to tell you what the Fed's going to do before the Fed even knows what they're going to do, which is hilarious.
Yeah.
So then why do you even care about what the Fed says? Which I don't. But
I meant Treasury yields are done going up then, rather than the Fed funds rates, which is really the same thing.
Yeah. Like yields can also go up sometimes or yields can go up and down because also speculators can pile in, right? I'll say that
one last final pop, but thinking more long term, I think this is kind of the end of the raising rate cycle. And then the question is, why not sell all SPY and go into UPRO?
And just play yields coming down?
Well, no, I was saying basically it's time to leverage up.
Well, you're thinking equities go long, to go long equities. But you could be wrong on the timing. Because I think equities are pricing in mild recession, not severe recession. I'm gonna be blunt and kind of just say that after today, again, I'm kind of thinking about changing lending practice right now. What that's gonna do, I'm actually almost thinking the inversion was right. We're gonna have severe recession.
I thought we were already in a recession.
We are already in a recession.
Oh, we're already in a severe recession, bro.
No, I wouldn't say we were in severe. We're in mild right now. Severe, I mean, things can change very quickly, which is it kind of has me a little bit concerned. And then what that would mean? That would mean the office REITs kind of crashing today. is very much in line with that. Oh, let me see what let me see what these stocks did today, because that matters too. No, not much of a movement.
Yeah, I think office REITs, if you were to see like a 5-year recession, they're probably not coming back up after the recession's over. So those long-term leases expire.
Yeah, these ones aren't moving too much, so no, it's not like a
If
consensus.
only Capital Mindset still had its resident macro guy.
No,
He's-
it's the thing is though, has anything in terms of, well, I know that was a joke, but like, has anything in terms of like the macro from the Sunday calls, has it really changed?
Oblio, you gotta answer the question.
What
I'm
question?
20x leverage, bro.
Oh, is Fabio doing a video right now? Yes, this is recording.
Yeah, but like,
Mhm.
like has anything really changed all that much? Like, I think not to be JPOW whisperer, but like it seems like he's trying to say he's gonna Volcker this stuff.
Well, what's changed is treasury rates reached a peak, I would say. Like they were going up, we're going to do 50 basis points. We're just going to keep fucking hiking. And then it was like, never mind, we're not hiking shit. Because, I mean, that news hasn't came out yet. I would expect it next week.
I don't know if you guys can hear me, but Powell will never be able to Volcker the economy because, I mean, or at least pull off like the massive rates Volcker did for securitization and leverage that would absolutely wreck the market.
And we also had Bank of Canada pussy out on raising rates this week as well. So I would say, yeah, we're at peak interest rates, and that's what's.
Oh wait.
Bigger pain.
Has help me out here, guys. Has the federal government stopped lending right now? Oh, sorry, borrowing. Because I've been entrenched in busy season, so it's like hard to keep up. I know there's like a debt ceiling thing conversation. Have they stopped borrowing?
No clue.
Yeah.
I mean, they've still not reached an agreement, I don't think.
But what I'm saying is the government right now not borrowing and reaching into its reserves?
I would imagine it still is. We probably would have heard that the government shut down or some bullshit. Like that's usually what happens when that.
No, because I know they have a decent amount of months of reserves typically. Usually, if things like this happen, it's fine for like 6 months. But no, very important. Have they stopped borrowing?
I have no clue.
I need to find this out. Gosh, why is Google so terrible at just giving me the information I want?
Just ChatGPT it, bro.
No, I don't even think ChatGPT will find it because it's just going to use Google or Bing.
Bing AI.
Yeah, it's just terrible search engines, pretty much.
Because I think that we're still in the window of the Treasury Department having access to the extraordinary measures.
Yeah, that's what I'm saying. Are they in the extraordinary measures? Have they essentially stopped borrowing?
I think.
Have we reached the debt ceiling? Is my question.
Oh yeah, we hit the debt ceiling. Like that was like earlier January, I think.
Yeah,
Or
Jan 11, 2023.
Yeah.
Okay.
Yeah, but I forget like the exact mechanics of the extraordinary measures.
Start borrowing.
Yeah, it says they reached the debt ceiling, but then they made a suspension period, so they're still borrowing.
Spending investments in certain funds, the Treasury temporarily reduced the amount of debt these funds hold, which would allow the government to stay under the borrowing cap and continue standard operations for a longer period. You know, it's just redirecting. It's redirecting. Yeah, it's not really any Net new.
I posted it in chat.
Oh, let me come back to chat. Limit
It's
was
from a
reached.
government website.
Debt issuance suspension period during which, under the current law, it will take well-established extraordinary measures to borrow additional funds without breaching the debt. Yeah, that's what I'm saying. It's not net new. It's just redirecting from other parts of the government.
Yeah.
Oh.
Yeah, like the funds that they throw into some like reinvestment for like retirement funds that the government has or like is partial to. Yeah, those are like the clear extraordinary measures that those are paused and redirected. So I'm not seeing anything about like stopping borrowing per se though.
Was this is not this part. It's just like this change is okay. So putting it together. Rate of change happens January. We talk about liquidity crunch last year. We get into 2023. I mean, we talked about the global dollar shortage last year. Lots of international entities selling and trying to get dollars. You enter 2023. Now we have this guy. Oh God. That.
There we go.
You found something?
Yeah, hold on. In theory though, this is old news though. Like it should have been metabolized by the market. Considering it's a frickin' .gov PDF.
No, my question that I think this already answers is net new amount being borrowed, not redirected.
No.
The answer is no, right?
No, not that I'm seeing.
Yeah, so it's just moving things around, but staying under the limit.
Yep.
Okay, that's what I was.
Yeah. Declaring a debt issuance suspension period under subsection A. Well, part 1, subsection A.
Okay, putting that together, that really goes into the theme of the starvation of pristine collateral, like putting that into overdrive. If the financial system is going to get starved of this, I mean, that has really strong repercussion. Like, we could see a really strong reduction in lending rates.
Just say we're gonna die, Brett.
No, we're not going to die, but we can
I'm
go
still
into
gonna
a
borrow
pretty
from a
strong
friend.
recession. That's what that means.
So like, you said strong recession, right?
Yeah, we could get into a really pretty strong recession. Like things can change a lot faster than anyone thought, which would be hilarious because that'd be like all the yield curve, enthusiasts were like, "Oh, you see."
Yeah. Well, that's a good thing because that means more people are gonna die. So, because economic suicides, right? So.
This is a recorded
We're on
call
to
at
the
Kingdom.
moon. Oh shoot.
Keep it clean, Kingdom. Keep it clean. Keep your racism down.
Bacon. Ousting him. Taking out everything. On my way to the bank right now, taking out everything. No, this is because it continues with certain themes, certain behaviors that we were observing tail end of last year. So now I'm like, I don't know. I gotta think on this for the weekend. This is like, I don't know. Oh my god.
I don't know. I still wouldn't be surprised if it's more of a mechanical thing, like someone blew up somehow.
Oh my God, we're all gonna die.
No, we're not gonna die. We're not. It's not
Oh
Great
my
Depression. No, it's none of
I mean,
that.
I mean,
Relativism,
technically
guys.
we are going to die eventually.
No.
But
Relativism. Oh yeah, we all are gonna die. Sorry.
yeah, eventually.
All of you watching the
We're
recording,
gonna die.
you're all not gonna be here one day.
Yeah, mortality.
I'm not saying Great Depression. I'm not even saying Great Recession. It's just, severe, high potential now, severe recession, no longer mild recession, which would be a scenario where equities get to lower lows, because
Wait. A severe recession would be where they lower interest rates prematurely and start fiscal spending.
But that be wary
do
of
that after
be
we're
wary
in
of the direct effects, or like the timing of those effects. It's not instant. Nothing's instant like that.
The faster we take our money out of the bank, the faster they'll start fixing stuff.
And remember,
Flavio,
yeah.
Flavio, are you saying? Oh wait, hold up. This is all for the U.S. Sucks to be you. Us Canadian banks are good.
No. Do not underestimate spillover. Do not underestimate spillover.
Yeah, the Canadian banks hold treasuries too, bro.
Yeah. But we're smarter, okay? We kick the can down the
They
road a
hold
lot.
US
If
treasuries.
your
even
banks
if-
survive, you're still going to be unemployed. Just
No.
Your banks will survive. You will still be unemployed. That's really good. That's good. The Canadians are like, everything else dies before the bank.
at least our financial
Literally,
system's good.
I can see that. No, literally, I can see that.
That's what they do every time.
The
Banks
Canadian
all
people
survive,
will
but
starve
everyone
before we allow the Royal Bank of Canada to go under.
Where is Cole at with her boots on the ground expertise on what's happening at the banks?
Still busy, fixing his fucking eyebrows, like I fucking knocked his ass out.
We need Cole to tell us if a bunch of people walked in and withdrew everything today.
Yeah, I think Cole hasn't said anything of like oh whoa, we're listening to some Mandarin here from
Oh, yo, Samantha.
the Kiwi.
Samantha, we could hear your ass. Yeah, you better quiet down.
No, he doesn't hear us.
Balloons.
But
Yeah.
I'm gonna mute him real quick, just for the sake of the recording, so it doesn't pick him up. So, oh boy,
The suspense. Just say we're gonna die and we can move
no,
on.
not we're gonna die. It just changes strategy, changes thought process, right? It changes focus, or maybe
Does it
makes me more
really?
excited.
Yeah. Just buy Parkland, bro. Like that's
I was
all
gonna
you
say,
need.
but does it really, like? Because odds are, if it's going to be like a short term or relatively short term, short thesis for something, then wouldn't it already be a crowded trade? And if it's long only, then aren't people already sitting with some cash on the sidelines? Or is it just me and I'm just that dumb, but somehow I'm lucky?
No, if you're sitting on cash, I mean, yeah.
Like not all cash, obviously, but some.
Well, I would hope that all of you aren't like 100% invested with no new money coming in.
Yeah.
Hello.
That scenario would be the one that I'd be like, ooh, but yeah, 100% cash. Sorry, 100% invested, no cash coming in. You're just like, that's it. That's all you got. Yeah,
Stop attacking me.
Stop attacking me.
That could be. It could be worse. Though. It could be like 100% leveraged without any cash.
Yeah, I already got the fear out of my system. I got 18 months emergency fund, bro.
Yeah.
So I'm all good.
Oh, you're phenomenal then. Like if we get something, but my point is like, it might change like the no, it really won't change my aggression, because I'll just still be deploying pretty much same as always. Gonna keep doing the same in the holding company, and I'm with the holding company. I try not to hold cash. So right now there's no cash, but there's gonna be new cash coming in this month, and then.
To be fair, I'm on the S&P 500 basically, so it's not that bad.
No. Okay, I just want to reiterate. I'm not saying Great Depression, Great Recession. That was a weird event, but I'm saying like now this kind of changes it. Okay, Bacon. To be more precise, it changes the timetables on certain things. So if I think now the rate of change in lending is going to now dip to the negative because this weird black swan event we just witnessed might, and I don't know the answer to that, might have changes in lending practices in the near term. And where I think the consumer is kind of leveraged or it has an umbilical cord to the credit extension. I start to kind of draw some questions about the severity of the upcoming, or not the upcoming, because like I said, I agree with there too. By the way, we have been in recession for I'd say about 6 months, depending on who you ask. But I'm saying this duration and severity of the recession now comes into question. I don't think duration really is known yet, but I'm starting to lean in more on before remember my commentary before. What did I always say? I don't know the severity of the recession, but now I'm kind of going, oh, I don't know, like that. If it has an effect on lending practices, I will say with great confidence that I could be wrong. Great confidence, we're going to be at more on the severe side of a recession. If it doesn't really have an effect on that, no. I think we're kind of still in line for like mildish to almost kind of medium recession. Maybe more in the medium, but not really a severe. Let me say, like 2008 is catastrophic recession.
So I got a question. So you're saying, okay, define severe. Like, what do you think the unemployment rate is going to be at a severe recession?
Unemployment rate with like standardized or normalized participation rate, it like 8%, around there, 7%. Just throwing numbers.
Hey, you guys said earlier when I said, oh, well, they'll just come in, lower rates, do fiscal spending and stuff if we get to that severe recession. And you're like, yeah, but they don't do that right away.
No, it doesn't have a direct effect.
When COVID hit, they had all that shit done within a month. They had that fiscal sprinter on. They had the interest rate lowered. It was like instant.
Yeah, but the interest rate change QE doesn't have the direct economic impact that everyone thinks it does. If that's the case, then other countries who do it on more.
Well, no, because this time the recession would be caused, or rather, most of it is caused by these banks with these treasuries that if you lower interest rates, it would automatically be fixed.
You have a more of a direct effect on like the short interest rates, but not the long.
Yeah.
So
I'm saying if the Fed lowered interest rates to 0 tomorrow, that it wouldn't cause 10-year treasuries to.
No, 10-year treasuries are already going down in rate without the Fed's intervention.
I know.
Yeah, they don't.
I know, but I'm just saying, like, if they did lower rates, say, like, I don't know, 1 whole point or 1%, it would fix everything that these banks are having issues with. Because it would put them back into, fair.
I don't know. I just don't think that this is even black swan territory.
I don't think they would do that. I'm just saying that would fix it, though, if it really got bad.
Like,
Thing is, they don't.
It's like the albino mouse.
The albino mouse is not the.
Yeah, not the most it's not the most common thing, but it's definitely not unheard of.
Okay, I gotta say, like, all this is sounding like we're all gonna die over this one random ass bank that nobody knows.
No,
like,
I repeatedly said no. We're not. We're not all gonna
Bro,
die.
you didn't see those other banks drop 20% today?
The ones that I also never heard of. Yeah, sure, yeah, those ones as well.
I mean, they had like 200 billion in assets. It's not like a tiny bank.
Yeah.
But sounds like he wants a 6 card. What the bruh?
It's actually it has, by the way, for only having 200 billion in assets, it has a large amount of ripple effect. So let me kind of explain a little bit. So what I see a lot is a lot of asset management companies have their funds or accounts at these banks. Specifically, I'm thinking SVB and the other one being First Republic. Those are really big ones. So hypothetically, both go under, those asset managers, all the stuff that wasn't insured above the amount, it's gone. It's all gone. So, okay, does that mean that, nothing else happens? No. So they have assets like, shares, stocks, etc. Now, what are the implications of what they have to do now with all that? Well, they're probably going to have to sell. Remember, those assets are usually, when I see them, they're held at other banks. They're sometimes held at J.P. Morgan, Charles Schwab, Goldman Sachs, Morgan Stanley, Interactive Brokers. They do a lot of business like that. You see their asset measure, right? You see like, oh, they have, I don't know, $1 trillion in assets, whatever. So a lot of that is, they're just custodians for those assets. And the trigger, the selling point isn't really caused by them. It's caused by these entities that they had maybe, like I'm throwing out a number here, but you imagine if it's real or not, like 100 million with SVB. Well, now the 100 million, poof, gone, right? In this scenario. So it doesn't just stop there. It has ripples through their operations. Now, there's a lot of things that come into question. They're gonna have to go through a litigation process, at least for I don't know, an unknown amount of period of time to get that money.
It could take like a year to get their money back.
Yeah. Okay.
So like it's funny because people think, oh yeah, FDIC. So there's a misconception. Some payroll didn't go out, and the FDIC will basically give them, they'll give the company $250K on Monday. So people are like, yeah, we're going to get our paychecks on Monday once they get that FDIC money. Well, if they owe $1 million in payroll for this week and they're only getting $250K, you're not getting your full paycheck.
Mm-hmm.
And you're not getting that paycheck for a year, and they're not going to be able to pay you next week at all. So,
wonderful example.
Yeah. I don't know. I just suspect that there's a good amount of potential for wasted brain power here on this.
So I would imagine some people are going to be late on their rent, and you're going to see defaults, or not defaults, but late payments start tick up. Maybe defaults, yeah, because they might not be able to pay their rent for the next year if they can get their paycheck.
Yeah.
Shit.
Look at the GIF I just sent.
Shit.
Yeah, look at the GIF I just sent. That's literally because it's random as bank died, bruh.
No. Okay,
Yeah,
so
these office REITs, they're probably not going to be able to pay the rent either. Not only that.
I don't know the severity of that. I'm kind of maybe trying to breach the middle here, because I would say it's not a random bank. Like, this actually has an implication for equities at large if a lot of these asset managers have to suddenly, I don't know, get some liquidity. Because if you have 100 million or something like that, that's now gone, right, or whatever, or at least now locked up in litigation before you can ever see that money. Well, you can't just oh yeah, just the 100 million is gone. I don't need to change any behaviors or anything like that. I don't need to sell any of my assets in order to shore up again and get at least some money out. No, you're probably going to change something, right? So it could put pressure in the short, medium term on equity, which would be great. That's actually a good thing, right? Because you can profit from those hedges. But if for example you see somehow, this would be terrible. This would start to get nuts. But if you start to see contagion, which that's the debate we had at the very beginning of this call 2 hours ago, was, are we going to see contagion? Yes or no? And we're kind of going to find that out next week, because this happened really fast. Well, if there is contagion, we'll see pretty fast as well. If we see First Republic,
attorneys take a large cut of do attorneys get involved, or is it just the bank and FDIC for the remaining funds? So if you got say 100 million in the bank, and their treasuries are worth 10% less, you're only getting 90 million. Mm-hmm. But then is there attorneys take another 10 million type thing, or what?
I am not too certain on that because I haven't participated in those proceedings.
No. Yeah. My suspicion is this is America we're talking about, so there's always lawyers involved.
Kingdom, Gondar is actually right. It'd be a great time to do the next episode.
Yeah. Not gonna lie though, not to engage in outright Schadenfreude, but 08, 09, like the common person got their teeth kicked in, whereas Planet Silicon Valley and Planet hedge funds in general got to live large. I mean, I'm not saying that the common person's in a great spot right now, but if the common person survives through that, Silicon Valley can tough it out, tighten up their belts.
Yeah,
Because mechanically, like that's what the low rates did, was it boosted Planet Silicon Valley.
well, yes and yes.
Yes and no. I know it's of course it's always more nuanced than that, but like not to go also like full Brexit here, but like one person I remember a great quote where like it was like some politician saying we can't do Brexit because we'll our GDP will get hurt, and then some common person said, yeah, your GDP. So it's
So I got a question, Flavio. So with this recent events occurring, will you be looking at Service Corporation, bro? Because economic suicides, it tends to go really high during recessionary periods.
Is that really actually going to move the needle? Oh, come on.
What?
Yeah, no.
I'm just asking a genuine question, I'm just saying, we're here to make money,
No, what I'll be honest is, this is what Bacon's waiting for me to say. Is it really going to change my investing approach this year? Probably not.
yeah, like does it change that or my life or most of our lives here?
Well, I don't want to be insensitive. Well, I'm not saying you're insensitive. I want to be careful how I say this going forward. But like, I don't know if someone listening to this recording is going to be affected by the events to follow, and if it is, apologies. But yeah, it's not going to. I don't think it's going to be as bad as 2008 for sure. I can say that with confidence.
And even
right
then, like if you're like not even like higher up in the Planet Silicon Valley activity, and you get your teeth kicked in, like heart goes out to you, but I'm sure you'll be able to land on your feet. It's life.
Well,
like,
Bacon has a vendetta against the Silicon Valley guys.
No.
He keeps mentioning that in passing. He's like, yeah, those Silicon Valley elites. But Bacon, just so this is not, even though they're Silicon Valley Bank and stuff, it has.
Oh no.
Yeah.
I know it's not. Like for example, the wine growers, like they definitely bank. Some of them have banked with, say, First Regional or Silicon Valley Bank. Like I recognize that. But then again, like I'm not gonna be completely ignorant of the fact that some of those vine growers thought to themselves, "Oh, aren't we clever? Well, the greater Midwestern, farmers plant with only wheat or corn and basically monocrop, even though they do the exact same damn thing in a largely arid or desert area." Yeah, and they can go. Oh well. It's just people. It's just people being people. That's all it is.
Wait, is it still recording?
Yes, this is
Probably.
still recording.
Bruh, it's like 2 hours now, right?
Yeah.
I'm going to close up the recording. So this kind of also makes up for the Sunday call that I skipped this Sunday or last Sunday because work. So yeah, Jason asked if I could upload this immediately. So this one's going to be uploaded, and it's going to be for all Capital Mindset members, Discord, gold and non-gold, and for Sense as well. I'm going to be posting this basically as a macro update of sorts, because I think the goal at the end of this recording serves a couple purposes, because we saw that some people, actually maybe we did a bad job towards the end. So closing off, you still shouldn't freak out, because that's how we started this call.
No. You should we're all gonna die, so do that, and then I profit because I got park lot, so it's all good.
Okay. Kingdom has a very dark thesis and dark agenda. He's trying to boost up certain numbers. But okay, so other than that, that's what I just want to close off with, and I will see you guys on the next one. Bye.